Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room for June 14th, 2021. We have some really fast market conditions this morning with the gold market coming down to the extreme levels below even the daily B2 level, which is the extreme below the mean, the average of 1857. The low was, we're looking at 1845.70 for the gold market. And we're back up to 1868. One of the things that I want to point out on this segment here, today's trading, is the classic example of the principle of reversion to the mean trading that we do. The trading that is taught at the Equity Management Academy is to apply the VCPMI, which stands for the Variable Changing Price Momentum Indicator. And that is essentially an algorithm that was written in easy language in C++ in TradeStation platform, which is what we're using right now. And what we have done is we have simplified the process of volatility mathematically. For those new viewers that are joining the channel, that are coming in here for the first time, what you're looking at is basically a very specific structure that identifies 5 pivot points, which is what these are. These are proprietary formulas that we use. And within those levels, it gives you the ability to, by turning on the algorithm, transform these pivot points into mathematical probabilities that identify a high or low probability, meaning the structure identifies the average price. This is the daily structure that we're talking about, but the methodology can be applied to the daily, the weekly, the monthly, any time frame. But it's a very specific structure. It does not use more than 5 levels, which is a perfect Fibonacci structure. And within those 5 levels, the algorithm ignites the pivots by identifying the probabilities mathematically, in that it identifies for you the average price. Once we can identify the average price, then we can extrapolate the extreme levels above the mean or below the mean. And if we look at the market right now for this fractal, today's fractal and price, we can see the market came down below the buy 2 level, which was extremely oversold, and reverted right back up in this huge green bar, which is essentially what the AI prepares us for. The artificial intelligence, by identifying these levels in color, in blue, tells you that this area is the highest probability mathematically where you can identify buyers coming into the market. When you look to enter the market at the buy one, buy two level, you're looking at a long side of the market with a 90% probability from buy one and a 10% probability for shorts, for selling the market. From buy two, you're looking at a 95% probability to go long upon the reversion unfolding. It tells you this is the area where you can expect this kind of action, which is essentially that they brought the price down where it identified buyers, the solid floor of solid buyers, and reverted. And those buyers took all these supply that came into the market from early morning to currently where we are trading, reverting from there and activating the principle of mean reversion trading, which is essentially that you want to enter long positions, the long side of the market, when the price completes this pattern, completes testing the levels in blue, which stands for accumulation of supply. If you want to accumulate, this is the area where you want to buy into this area, average down. If you're doing multiples, if you're doing shares outside of the futures contract, which is very limited in terms of volume or multiples. Not very few people. Only, I would say, very few people, institutions can handle the volatility in the futures markets. And unless you're going to take delivery of the futures markets, you want to be prepared for large volatilities in margin calls and be prepared, if the price comes down and the exchanges come in and raise margins, and, you got to be prepared for all of that, because otherwise you will get wiped out. They will raise the margins at the most extreme optimism or pessimism and force you out of the market. And that's just what's called margin exchange rules. They have the power to do whatever they want. Coming back to the market, this green bar is the market. It's telling you that there is very, very solid buying coming in here that took out all the supply. Now the price met the target of B1 on the daily, and upon closing above this 1868, that we're looking at the 1887 target next. Want to take a look at silver here. If we take a look at silver, the price came down again into that very similar area in blue. Now, I'm using this chart, a different chart, because this is the chart that I use myself to trade myself and execute myself, combining the daily, the weekly into one chart. It gives you a perspective in terms of the price relationship between the daily algorithms, which are on the left of the chart. And for today, you can see the average price for the daily is 28.11. The buy one level is 27.90. The buy two level is 27.75. And the buy one level here between buy one and buy two daily is about a 90-95% probability that the price, upon confirmation of the signal that came in at 11 p.m., it activated the short trigger. It came down to meet the target of buy one, buy two, and even below the buy two, which essentially made the daily extremely oversold, and we saw the reversion unfold. From the low of 27.56.50. Reverting through the buy two level, activating the buy two, the buy one, and going through the weekly average of 27.99 with the next target, which is the daily average of 28.17. So once again, the AI of the variable changing price momentum indicator in telling us to prepare for a reversion to unfold was extremely accurate once again. And this is what we advised our traders in this live trading room early this morning. If you traded from the levels below, in blue, the buy one or buy two levels, then the targets above become, or the levels above become the targets. And as you can see here, it's been completed, except for the daily, and we're looking at 28.17. That will complete the daily pattern. And the weekly pattern will be completed at 28.51. Let me come back here to the signal that was activated earlier in terms of stops, protective levels. When you enter a position, the AI gives you three choices of stops. It tells you do not use a straight stop. And if you're a conservative trader, the first stop is when you enter the position a close below, the level below. You can use it on a close below. If we activated a buy, if you went to the long, let's say from 27 or close to 27.54, 56.50 was the law. You can use 27.54 as your conservative stop. If you went long from 27.75, use the 27.75 level, and so on and so forth. That is your conservative stop. The aggressive stop is essentially a monetary stop loss that you can use, what I call a catastrophe stop, which is, in my case, I use $1,000 in silver because it's a highly volatile market, 20 cents. can happen relatively fast. But from a money management aspect of it, use that as a measure according to your profile. Um, you have to be comfortable with that dollar stop. But if it stops you out, re-enter the market upon confirmation. What the maximum dollar stop is, it prevents the equity from depleting if the signal needs to be tested or it's testing lower levels until it resumes the reversion or the reversion unfolds. You can be flat and re-enter upon confirmation once again, which is what we did here this morning. On silver now, the current signal is we were neutral on the daily targets completed. Now it's neutral. The weekly trading above 27.99, which is the weekly mean, is activating now a bullish price momentum with a target of 28.51. So let's watch the silver market here as it trades between the daily and the weekly average. The gold market is trading following pretty much the similar pattern as you can see here, giving you kind of a little better picture because we again incorporate the daily, the weekly, and now we have the monthly. 1850 was the level of support monthly. This 1850 level is the sell 2 monthly level that we reverted from a few days ago or last week. And by closing above the monthly sell to level, this level becomes major support for the next price fractal. And as you can see here, the market confirmed that and that this level is a very strong level of support, reverted, and now it's produced weekly buy signals at the buy 2 level with a 95% probability. It activated a buy signal from the buy 1 weekly level of 1865 with a 90% probability. The near-term target was completed, but a close above the buy 1 weekly now activates the target of 1886. 1886 is the next target. One of the things that I'm doing here specifically on this segment is to point out to you how to trade the market from a mathematical point of view. I really haven't even intentionally looked at the news or what's going on, but it's pretty much the same old, same old. Stimulus, inflation, um, a lot of opinions that are not connected to the market. And that's what the gold market obviously is reflecting on, that on the face of all of this extremely bullish fundamentals, which is essentially indicating that the US dollar as the reserve currency, is at jeopardy due to the tremendous increase in the stimulus, or we're looking at an $8 trillion balance sheet on the Fed in terms of the uh, money supply available. It's staggering the amount of supply in US dollars available, which is really putting, I believe, um, the US dollar as the world's reserve currency in jeopardy, questioning its purchasing power, obviously. And I think, when we go back again and I reflect to these fundamentals here time and time again, because the change in paradigm that took place was in March of last year when the gold market collapsed around the middle of March. 1167 was the low that we made. We look at March here. Last year, we came down to a low of 1450. Massive, massive decline from the 1700 level on the pandemic news. And this is where the market made the transition that I keep referring to, where the US dollar became a commodity and pretty much gold and silver became the currency. The markets always know and anticipate what potentially the price is going to do. And if we look at here, 1164 in silver, the same thing happened. This is when silver became currency and the US dollar became a commodity. And so what's happened here is obviously they have produced staggering amounts of supply in US dollars. And going back to the basic law of supply and demand, more supply, less demand, the price is going to be reflected. And people do not want to own dollars right now or hedging or hedging on this potential prospects that if they continue to supply this free money, this helicopter money, whatever they want to call it, this staggering amount of money supply that's in the market, um, can only lead us to some very very uncomfortable economic resolutions. And I think that, again, that is what the majority of assets are indicating. If you take a look at real estate, the price of oil, commodities in general obviously have begun to tamper with the idea that we're moving into an inflationary cycle. So the magic word out there is inflationary, inflation. And if you take a look at lumber as an indicator, first of all, one of the key economic indicators, it's the indicator, you might say, for construction, for real estate, and for building in general. And what we have seen here, I'm trying to get the chart, bear with me a minute. Lumber has come down to 1,029. just fell off, just collapsed. And it looks like today was a major low that we made of 996. So we broke $1,000. And wow, just a little while ago we were at 1,700. So this is going to reflect obviously in the home construction availability or the ability again to maybe resume home building construction, maybe bring some supply into the market, and obviously this reflects very well for the overheated prices that we've been looking at in terms of the lumber prices as it affects the value of real estate right now. So the low actually in lumber was 971, and that came into a 61.8% Fibonacci retracement. So to indicate to you that I believe the inflationary fears that we have in the market here, is not supported by the 10-year note. And it's not supported by copper. Copper has come down quite a bit from the highs that we made here in that 478 area, and we're trading, pretty much at 452. So we've come down quite a bit, I think, in terms of some of the basic materials that are used to inflate the idea of hyperinflation. I don't want to miss this market here. The virtual currency markets are just exploding here. We got coin up 13% in one day. I'm sorry, up 6% in one day, up 1350. 1350 on coin, and we're looking at GBTC, which is the Bitcoin trust that we trade, is up almost 10%, which is a phenomenal move. So continue to hold the digital currency position, because this is exactly what I'm referring to when I go back and I say the loss of confidence in the dollar is really what's being reflected in virtual currencies. It's not yet reflected in the gold market, but don't give up, because don't forget, gold and silver have been real currency for thousands of years. And what you're looking at is a completely new asset that's being created by demand as a result of this tremendous virtual economy that we're moving into, that essentially will take us into space. And obviously in that world, you need some kind of a currency that you can deal with, which is a virtual currency, because fiat currency just doesn't make any sense, does it, when you really think about it? And carrying silver and gold is a little heavy, so this is what happens when the masses, the need of the masses, essentially are reflected in the market. And what they're saying here is that they're looking for alternative US dollar assets, even if it is virtual currency. Continue to buy money, continue to buy real currency, which is gold and silver. Have a great day, my friends. I'll continue to update you in the trading room. We have a very exciting day today. Have a great day. Have a great week. I'll talk to you soon.